Hey, good afternoon and welcome. My name is Matt Price. Looks like we still have a handful of people trickling in, but this is our monthly market update, part of our ongoing correspondence by webinar, where we're trying to give clients just some perspective of what we're looking at, what we are thinking. So we do 4 of these a year that are a little more in-depth. That was last month. For the other 8 months, we're doing a little bit of a lighter touch. So trains, if they run on time, this should be a 10, maybe a 20-minute presentation. We have 7 or 8 slides prepared to kind of walk through of what we're looking at kind of specifically over the last few weeks. So not necessarily super in depth, but if it does provoke any questions, comments, or even snide remarks, please shoot us an email, give us a call. We're happy to help. So most of the people on this call look to be clients. We're so glad you're here. For those of you that are not clients, Randy, he is my father. He tried to tell you he is my older brother, but don't let him fool you. We follow a fiduciary standard, have a retirement niche. Over 80% of our clients are, in fact, retired. A little bit about who we are. We're both certified financial planners. We both went to Wharton to get our CIMA, Certified Investment Management Analyst designation. That's a little bit of a mouthful. Randy's gotten awards from Forbes, Barron's. I was humbled to get one by Forbes last year, and actually our team got the Best in State Forbes award earlier this year. So if you're not on our email list, shoot us an email. We're happy to add you. Our firm, though, based off the biblical definition of stewardship, steward partners, and we're not owned by a bank. We serve as a fiduciary. We think that's really important. We have a couple of different custodians. Custodians just term where client assets are held. Most all our clients use Raymond James. They've been a really good partner of ours and very fiscally conservative company, which we certainly do appreciate. So let's jump in here and kind of show you what we have been looking at. Is inflation fading as it pertains to the risk of inflation? Short answer, we think, would be yes. Last week, if you're paying attention to some of the minutia, the stock market as a whole had a rather large sell-off because one of the inflation figures came in a hair higher than projected. But if we take a step back and look at it over the past 3, 4, 5, 6 months, you've had inflation slowly moving lower. I want to pull your attention to this chart here on the right. The shelter prices set to move lower in 2024. Shelter prices are what it costs to live in a home, to rent an apartment, etc. And we consider this a lagging indicator, meaning it's an indicator that typically happens after the fact. So after you see inflation fall, typically you see the shelter prices fall thereafter. And so that being a big component of the consumer price index, the CPI, we think there is some kind of, I'd say, wind at the back of still having inflation move a little bit lower. What you saw last week, food actually went a little bit higher to kind of counterbalance some of that. But overall, we think shelter prices moving lower should in fact bring inflation lower. And why is that important? Well, it lower interest rates essentially make stocks more attractive. More attractive stocks typically mean higher stock prices. So it would be a catalyst. That's what the market is expecting, that inflation should continue to move lower. And speaking of interest rates, shifting the perspective for what the Federal Reserve has said, over the last few years, they've been increasing short-term interest rates as a means to hopefully slow the economy down. And now I'd say the sea change, the tide is kind of changing, where here over the last month or two, the new kind of verbiage you're hearing talked about is when the Federal Reserve is going to cut interest rates or try to create more economic activity. And you can see here the chart on the left, projections from last fall, beginning of the year, and currently here at the Price Group, we think there's probably 3 to 4 interest rate cuts sometime this year. We think that's probably already priced into the stock market. meaning it's not just us, Randy and I, who think that. There's, I'd say probably general consensus is in that 3 to 5 cuts for 2024. So if you got 0 cuts, that would surprise the market in a negative way. If you got more than 3 to 5 cuts, we think it would surprise the market probably in a positive way. Chart here on the right, maybe good news, bad news, depending on how you look at it. This is the federal government's balance sheet. And the kind of the north-south, the y-axis is stated in trillions with a T, which is kind of makes your head hurt if you really take a step back and think about it. But you saw a huge increase, obviously, during COVID in 2020. You saw incremental increases kind of up until 2022. And we've had more of a downward sloping glide slope since then. So we've shaved off about $1 trillion of the balance sheet, which is good news. The bad news would be there's still over $7 trillion to continue to shave down. So overall, right now, trending in the right direction. The little blip on the radar, you can see here, kind of early 23, that was from the banking crisis. If you remember a few of the banks out in California and the West Coast that had some issues where the federal government infused some capital to make sure no depositors lost any dollars in the banking system. So overall, trending, but that's kind of when clients ask, what's the thing that keeps you up at night? What are you most worried about? We do say the federal deficit, which the balance sheet is not the same thing as the deficit, but they are very closely correlated. Economic resilience. What are we looking at here? Most people at the beginning of last year, 2023, expected some type of mild recession at the end of last year, and we just haven't seen that. So the economy as a whole just continues to kind of chug along. The labor market still looks pretty good, meaning there's not tons of layoffs. The employee still has the upper hand compared to the employer, meaning that there are more people that are trying to fill jobs opposed to looking for a job. And there on the right, the consumer sentiment is improving. You know, we said about a year ago at this time, you can see early 2023, the consumer was really, really negative on the overall market. And typically that's a good kind of contrarian sign. So when the consumer gets really, really negative, it's sometimes a good means to kind of move into the market, which is what we said about this time last year. Right now, the consumer is not overly zealous or overly confident about the future. So we don't think it's really the opposite, where it's time to maybe take some chips off the table per se. But it is improving, which does have a few good tailwinds to that overall thought process as well. And then just as far as stocks go, a strong start to the year typically means a strong year to finish. Look here at the chart on the left, as go January, so does the market. When there is a positive January to start the year off, the percent or the average performance is right around 10% positive for the year. But when there's a negative January, it's only about 2%. So January was positive, which is a good thing. Doesn't guarantee that the rest of the year is positive, but history, typically it doesn't repeat itself, but it often rhymes. And this is one of the rhythms that we have found out. When there's a good January, a good year typically does follow. Now, with that being said, we're a little bit more cautious in the short term. And when we say short term, think weeks to maybe a few months. And here we've listed a few reasons why. We've just had a really historic rebound in the stock market, really going back to the September, October timeframe. So it's been a good few months to be a stock investor. We think the market is just due for kind of a breather. We're going to send out a little bit more of an in-depth thoughts on the market email tomorrow on this topic. So stay tuned for some more in-depth commentary around this. But everyone is expecting economic activity to slow. We think if there is a recession, we do think it is mild in nature. Earning estimates could be too high for the next 12 to 24 months. Valuations of stocks are a little bit elevated. We'll talk more in detail here on which stocks specifically we think those are, and possibly too many investors are too bullish or too excited about stock market returns in the future, which is another good, what we think of, contrarian indicator. You know, Warren Buffett said it best. He said, "I get fearful when others are greedy, and I get greedy when others are fearful." So we try to adopt really that same type of thought process. But more specifically, the type of stocks that are a little bit maybe overdone in the short term. The term is the Magnificent Seven. These are the 7 biggest stocks within the S&P 500, and they all have to do kind of within the technology. You know, we have it listed here as communication services, but they're all technology companies for the most part. These are trading at a much higher multiple, a price to earnings multiple, when compared to the other 493 stocks within the S&P 500. So you can see here on the right, those stocks, how the returns have kind of shaped up here over the last couple of months. But the bottom line is this: we think the biggest 7 stocks are probably a little overheated. The other 493 stocks, well, not so much, but the market has become a little bit top heavy, as you can see in the title of this slide, with those 7 stocks making up a larger percentage of the overall stock market. So the takeaway we want from this slide, the last few slides, is this is the type of environment when it's, we think, really, 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 did I say really important to have an investment process, to know what you own and to know why you own it. Last year served to be a good year just for the overall markets. We think moving forward, there's going to be pockets of the market that do well and pockets that don't do well. And we think the security selection is probably going to play more of an important role here over the next 1 to 2 years than it has over the last 1 or 2 years. Election season is upon us. If you're anything like me, I'm getting 3, 4, 5, 6 election text messages every day, it seems like. And I don't know how my cell number got added to the database, but it did. Looks like Trump is leading in 6 out of the 7 battleground states as of about a week ago. And he does have right now a pretty sizable lead over Biden. This will actually end up being, on a global level, the biggest election year in recent history, just with so many different countries having national elections as well. And it actually would be if you look here on the right, party in the White House could change for the 3rd consecutive election for the first time since 1896, which is quite a few years. So we're kind of probably in a number of different ways embarking on things that are maybe new, but overall it's going to create some volatility. We think that is for certain, and right now it's a little too soon to tell on how do we position investment portfolios based on who might take the White House, who might not take the White House. But as we do progress, get closer to the election, that is something we're obviously going to be paying attention to. 4 years ago, we held 2 or 3 webinars leading up to the election, just kind of talking about our thoughts, not really on who we're supporting, but more so how it affects the markets, the stock market, and then also more specifically interest rates in the bond market. So as we get closer, we'll probably have a few of these monthly market updates that are more really focused on how politics, we think, could possibly shape the investing landscape over the next couple of years. So anyways, with that being said, about 15 minutes in, those are our prepared remarks. I'm Matt, he's Randy. This is the rest of the Price Group, Tiffany, Maddie, and Melissa. And we certainly appreciate you carving out a few minutes for us. Like we said earlier, you have any questions on the material we covered, or if this sparks a question on something else, pick up the phone, give us a call, or shoot us an email, and we hopefully will look forward to catching up with everyone very soon. Take care. Thanks.